Welcome to The Explainer. I'm absolutely thrilled to have you here today. We're unpacking the just-released Q2 2026 financial results for FB Financial Corporation, the parent company of First Bank. And honestly, it's a fascinating story of momentum meeting strategy. Usually in banking, it's kind of a tug-of-war, right? You've got aggressive growth on one side, careful risk management on the other. But as we're going to see today, FB Financial's second quarter is a literal masterclass in treating those two goals not as opposites, but as partners. We're calling it the Growth and Discipline Playbook. So our roadmap for today is straightforward. We'll hit the Q2 2026 headlines, then look at fueling double-digit growth, managing margins and expenses, navigating credit quality, and finally, returning capital to shareholders. Let's get right into it. Okay, Section 1, the Q2 2026 headlines. We're setting the strategic stage here. Okay, let's dive into this. Whenever we break down a company's performance, the absolute best place to start is right at the top. This quote from President and CEO Christopher T. Holmes perfectly sets up our whole theme today. He points out three absolutely crucial pillars: double-digit loan growth, solid core earnings, and stability in their net interest margin. Now, if you know the banking sector, achieving just one of those in a given quarter is a solid win. But hitting all three simultaneously? Yeah, that indicates a highly coordinated operational strategy. They aren't just growing for the sake of getting bigger, They're growing while keeping the fundamental health of the business rock solid. And here's the hard data actually backing up that executive optimism. An adjusted diluted earnings per share of $1.14. This isn't just a minor bump either. It's a solid increase from the $1.12 we saw in the previous quarter, and a really significant jump from the 88 cents reported in the exact same quarter last year. So we're not just talking about top-line revenue shifting around. This is actual bottom-line profitability translating directly into value on a per-share basis. Moving on to Section 2, fueling double-digit growth, the engine and the fuel. To really wrap your head around this, think of a bank's loans as the engine driving its revenue. And deposits? Well, deposits are the essential fuel needed to run it. They're running a massive loan engine right now with an 11.6% annualized growth, bringing the total portfolio to $12.87 billion. But crucially, they're safely funding it with 7.70% annualized deposit growth, which brings total deposits up to $14.35 billion. They aren't overextending themselves at all. They're taking in smart, reliable deposits and efficiently turning them right into profitable loans. Now, what's really interesting about this slide is exactly where this diversified loan money is going. When you grow loans by double digits, you definitely want to know what sectors are being fueled. As you can see, a massive chunk of their exposure is concentrated in residential development at 33% and construction at 25%. This tells us First Bank is actively financing the building of actual homes and commercial infrastructure. They're capturing the upside of real estate development while safely diversifying the rest across various other sectors. All right, Section 3, managing margins and expenses. We're looking at internal controls and profitability. Look, explosive top-line growth is fantastic, no doubt about it, but it's kind of meaningless without strict internal controls behind the scenes. So before we look at those numbers, let's briefly demystify a critical piece of banking jargon: net interest margin, or NIM. Simply put, it's just the difference between the interest income a bank earns from the loans it gives out and the interest it pays to you and me, the depositors. It's literally the absolute heartbeat of a traditional bank's profitability. So the crucial point is this highly stable 3.95% net interest margin. In an economic environment lately where interest rates have been, frankly, all over the place, and the cost of holding deposits has been fiercely competitive, maintaining and actually slightly increasing this margin from 3.94% last quarter is a massive operational victory. It basically means their loan yields are effectively outpacing their deposit costs. Now, looking at this net interest income roll forward, you can see exactly how this builds into real dollars step by step. They went from roughly $146.7 million in Q1 to nearly $149.8 million in Q2. You can clearly see the sheer volume of their loan growth added over $4.1 million to their income. And interestingly enough, just having one extra calendar day in the second quarter added another $1.6 million. While there were, of course, some offsetting costs related to deposits and cash changes, the net result is a highly profitable organic jump of roughly $3 million in just a single quarter. But, profitability isn't just about making more money. It's also about spending it wisely. First Bank's adjusted efficiency ratio improved to 52.0%, which is down from 54.3% in the previous quarter. Now, in banking, a lower efficiency ratio is always better. It literally means it's costing them less money to generate every single dollar of revenue. This improvement was driven by lower personnel costs and optimized operations, which proves their internal financial discipline is working perfectly hand in hand with their external growth. That brings us to Section 4, Navigating Credit Quality. Let's talk about active risk management. So, whenever a bank grows its loan portfolio by double digits, we have to impartially step back and ask, are these loans actually safe? The data shows a slight rise in non-performing assets to 1.14%. However, context is everything here. This increase wasn't some systemic failure across the whole portfolio. No, it was driven entirely by the migration of 3 very specific lending relationships, and management has already isolated them. 2 of the relationships have individual reserves set aside specifically for them, and the third is well collateralized and actively managed. So they've identified the risk and they've ring-fenced it. And if you're wondering about the actual realized credit losses, like the money that is truly gone, that brings us to this incredibly low number, 0.06% annualized net charge-offs. Despite that slight uptick in non-performing assets we just talked about, their actual realized losses remain historically small. This tiny fraction is the ultimate proof that their underwriting discipline is incredibly strict on the front end. They're protecting the bank's capital even as they aggressively scale up the business. Which perfectly sets up Section 5. Returning capital to shareholders. This is the ultimate payoff. Ultimately, the whole goal of combining double-digit growth with strict discipline is generating excess capital to reward current shareholders. But before a bank can return money, it has to prove it's totally safe. Well, these 2 robust metrics confirm that First Bank maintains a highly secure, regulatory-compliant foundation, a tangible common equity to tangible assets ratio of 9.49%, and a preliminary total risk-based capital ratio of 12.9%. This shows that even with their aggressive lending, they have a massive shock absorber of capital. They absolutely have the financial strength to both absorb potential economic bumps and invest right back into the company. And this brilliantly illustrates exactly how they are deploying that financial strength. In just 1 quarter, First Bank repurchased 3.01% of their outstanding common shares. That is a really significant move. By buying back their own stock, they are confidently deploying their strong capital position directly back into the value of the franchise. It essentially increases the ownership stake and earnings power of every single remaining share. Honestly, the entire Q2 playbook we've discussed today comes down to a strategy that sounds straightforward, but is incredibly difficult to actually execute. Take in smart deposits, write profitable loans, diligently control your expenses, and return the profit to your shareholders. That is the engine humming perfectly as they position themselves for the second half of the year. So, what does this all mean? I'll leave you with this final thought. We've seen the playbook in action for Q2, but as we know, the real test of a great strategy is consistency. How will this disciplined capital deployment and strong organic momentum position First Bank for the remainder of 2026? It's a super dynamic situation and something we'll definitely be watching closely. Thank you so much for joining me today on The Explainer, and I'll catch you next time.